If you're accustomed to working with Tom DeMark style trendline projections, you've probably realized by now just how absolutely uncanny that technique is for predicting price moves, sometimes almost to the exact pip. So an interesting corollary of that is that when a price projection is completed, price can sometimes change course, which is more likely to happen in the case of a counter trend run. Price will often not go that much further than the projection, or in the case of a range-bound market. In the case of a strongly trending market, we know price most often, or very often at least, will blow by a projection and keep on going. But even if you've missed out the opportunity to jump on to a move, it's often very good practice to draw the projection from the earlier trendline break. Say it happened several hours before you logged on, and prices say 20 or 30 pips away from the end of the run or the projection. That might be just a little too close for comfort for you to try and sort of get in on that last few pips. But what you want to do is, if you were in that position, use the fulfillment of the price projection as kind of an opportunity to sit on the edge of your seat looking for clues to possibly get out of your move if you don't have a limit out on the trade, if you're monitoring it manually or in real time. And conversely, once that run has fulfilled its projection, to look for clues to possibly, not necessarily, but possibly trade on the opposite side of the market if there is now a setup of some kind to the other side. So let's take a look at a chart example that illustrates those principles. Okay, here's a perfect example of what I was talking about. Here we have, in the left half of the chart, we have a swing high occurring at the bottom of a move down in price. And as we'll see later, this was perfectly outlined by a divergence reading, which we're not going to actually go ahead and mark in here. But nonetheless, we have this swing high. In Tom DeMark style fashion, we hunt backwards looking for the last swing high. We connect the points. We got the break here. I measured the projection from the low of this candle up to the start of the trend line, which is the more aggressive Joe Chung style trend projection. I took that line segment, I put it next to the trendline break, and that gave us this dashed line projection up here. After price broke the trend line, it snapped back a little bit, tested old lows, not very aggressively in this case, and then continued on up. And as you can see, it took out that target literally to the last pip, which was just beautiful. So the scenario is either that you got in here somewhere close to the trendline break or at an opportune point somewhere down here, and let's just say the live edge of trading is somewhere around here where my cursor is floating, and we're looking at this thing and we're saying, okay, if we're in an open position, we're hoping it goes right up here. If you don't have a limit out shaved 5 or 10 pips off of that. Or let's just say we didn't get entry on this nice trendline break, and we're just too close to the end, though. We're not comfortable with the idea of trying to scalp whatever remains on this move. So what we do then is we just wait patiently, see what happens in the ensuing closes. So price comes up, just barely touches it. The next candle, which is a long-legged doji, as it's called, these price rejection wicks on either side of a negligible real body here. Tried it again, didn't go much higher. Then we had a lower close, a bearish engulfing close actually, and subsequently we noticed that we have a bearish crossover on MACD. Okay, now if we weren't out of our trade already, we want to be thinking about finding an exit possibly pretty soon if this was an intraday chart. And the other thing we notice is that this bearish crossover can do a good job validating a demand trendline break which came over here. This isn't really a Tom DeMark style trendline. What I've done, it's more like a common sense trendline. I've just attached from the interim low a trend line which gets multiple hits, but it was just as effective nonetheless. You could have done a price projection right off of here and it would have given you a target down here somewhere. But once you had this trend line broken, confirmed by this MACD crossover, price now clearly falling off. We have some price rejection wicks to the upside actually. You really should be out of your prior long position well by now, and this gives you the opportunity to trade the other side or the other direction of the market now that we have some clues as to a short move setting up. Now, there would have been other indicators and other time frames we would have wanted to look at to confirm that, but somewhere in this neighborhood we would have wanted to be thinking short, needing to be short at this point. So in any event, we can see how MACD does a good job confirming completion of a prior Tom DeMark style trendline projection if price is not going any further, and giving us an opportunity to go the other way. The seventh of our 8 applications for MACD crossovers is to use them in conjunction with events or signals or readings on other indicators and vice versa. The reason why we want to do this is that, first of all, MACD is not always very clear. Sometimes if you have a kind of a frothy or choppy market, you can get fairly jittery signals from MACD. So it's good to get some clarification from other signals, or sometimes conversely MACD can be the one providing clarity versus unclear readings on other indicators. So what we want to do is stack 2 or 3 or 4 of them, depending on whether they're on the price panel or beneath, and try to get a clearer overall picture reading all of them together. Now, when you're considering which indicators to use along with MACD, it's very important to give consideration to the type or categorization of indicator. And this is an idea that's not mine. It's borrowed directly from John Bollinger's book entitled Bollinger on Bollinger Bands, which is pretty self-evident what that's all about. But he has a chapter in there where he talks about how if you cobble together indicators that are all from the same family, constructed somewhat similarly, giving off very similar readings, that's nowhere near as reliable as cobbling together a diverse variety of indicators from different families. For example, one each from volatility, momentum, and volume categories. So you don't want to use the Chond momentum oscillator with Williams percent R with the relative strength index. As excellent as each of those indicators are, they're just too similar to each other. Whereas a better selection would be to use the RSI, on-balance volume, and Bollinger Bands indicators alongside MACD as a very nice diversified complement to our favorite or our core indicator, which is MACD. So let's look at a chart example now to show how MACD crossovers can work with other signals. Okay, so here's a chart that's going to give us two really nice confluences of long entry signals or long setups, and we can see how the signals work together in conjunction with MACD to corroborate that. So on the top we have Bollinger Bands on price, then in the next panel down we have MACD, the relative strength or RSI, and the red line on the very bottom is the on-balance volume indicator, which is available from AccuCharts, which is really cool. Now, the first event that we notice is a reversal tag. Bollinger himself makes very clear this point that just because price tags one of the bands does not necessarily mean that that's a reversal event. We see here we have a number of closes below the band until finally we tag the band and then have both an open and a close back inside the band and several other closes not even touching the lower band, and it's only a confirmed reversal tag once this lower band starts to flatten out. So that's very important to realize. Don't ever assume that just because price is tagging the band that means a reversal. It does not mean that necessarily. So anyway, we have this Bollinger event here. The next thing we notice is MACD is giving us a really nice, clear, textbook bullish crossover confirmed by the first histogram bar painting inside on the opposite side of the waterline. Then happily, we see directly below that RSI had gone deeply oversold and was now crossing back up through its 30% oversold boundary, which is an inherently bullish signal. And at the same time, the on-balance volume indicator had hit rock bottom here. And one very simplistic sort of layman interpretation that I use for that is that the volume, the bearish volume, the volume taking the market to the downside had basically hit rock bottom, had run its course, and there was no further bearish volume behind the move, so it was now free to move up. So what we see from these indicators, MACD is giving us one signal, and that's corroborated by three other fairly diversified signals. And to finish this move off, what we could do is just simply draw on our trend line, our classic Joe Chung price projection to the upside, which was realized well over here where my cursor is. And you would have really had to hold on through some ups and downs through this move, but it was a fairly safe move. Your stop down here somewhere would not have been tested too strongly. So that's our setup confluence number one. We have a second one just a little bit over here. It's almost the exact same scenario, although the signals are not quite as strong. But we have a very sharp reversal tag here, which is confirmed both by subsequent closes inside the band, and the band flattening out. Then directly below that we have a bullish MACD crossover, and similarly to before, we have RSI having gone oversold, crosses back up through the 30 line, and now with the on-balance volume indicator, we've got a couple of little sort of quasi-swing points. We connect them in a trend line, and on-balance volume continues to respect that trend line right on up, and we see a really nice move to the upside unfolding. So what this shows is when you get these bullish crossovers occurring with bullish indicators on, fairly dissimilar other indicators, certainly Bollinger and the on-balance volume indicator, that makes the picture that much clearer for you and gives you good setup signals. Here's the last of our 8 applications for MACD crossovers. This one's a bit more esoteric. You may not realize this, but you don't have to draw your trend lines all just on price action itself. You can also draw them on indicators, and that includes MACD. Now, the process is a little bit more finagly or interpretative, I guess you'd say. You don't have those super clear-cut rules for how to draw them. What you want to do is you want to look for those bumps that happen on MACD, little bumps up and down, and use them as sort of quasi-swing points. And what you want to do is just connect them with trend lines the same way you do with price. And what this really helps you do is that when you have a trend line break on price doesn't always respect that break, of course. Sometimes it'll go against it a little ways, test the trend line, maybe even just go sideways for some time. But what the trend line break on MACD does is help you identify potential entry points once price is kind of settled down and is about to head off in the direction you are expecting. So it's just a really nice kind of secondary signal to help you not only confirm the reversal but also look for entry points. So let's look at a chart example that shows that. Okay, here's a chart which gives us a real nice classic Tom DeMark style trend line break. We had this clear swing point. We connected it backwards to here. For a change, I actually drew an extension as a dashed line. We then drew our projection measured from this swing high down to the start of the trend line, and that was a Joe Chung style projection, which gave us this target down here. So once we saw this clear trend line break, price actually started to go very sideways on us, and without any other signals to guide us, if I was already short, I might be scratching my head wondering whether this thing could possibly be gearing up to come right back up here and form a double top or some other way test this trendline break. It might cause me a little bit of worry. So to help resolve that dilemma, what I do is I look in the background for bumps on MACD. Well, I've got one here and I've got another one here, and those serve almost as like really clear swing points. So what I do is I just draw a trend line that connects those two bumps. And what I see subsequently is that MACD, by the time price has gone to about here, MACD has broken its own trend line, and is trending down with angle and separation below its trigger, and the histogram is painting in red. So if I had gotten in short really quickly after the break, somewhere up here, I would now be taking a bit more comfort in my position, seeing that MACD had broken a trend line as well. Additionally, if this was a higher level time frame, say if this was a weekly chart, if I'd gotten in somewhere up here close to the break, by the time price had kind of drifted gently down here, I would more likely than not be in a really nice profit position. So I'd want to drill down to successively lower time frames to see if I could find another good short entry signal and possibly add to my position sometime after this MACD trendline break. So that's a more unusual application, but as I mentioned earlier, it can give you good secondary confirmation and the possibility of adding to a position if you're already in the trade. Okay, we're now at the end of Module 2, and I just want to provide the opportunity for a quick recap. First of all, we just started this module defining the term MACD crossover, showing what they look like, how they operate, some conventional interpretations for what they mean. We then looked at a total of 8 different individual applications for MACD crossovers in the context of a potential reversal situation. One of those being anticipating crossovers on the underlying moving averages on price. The next being to help validate chart reversal patterns such as 1, 2, 3 tops and bottoms. And we noted how on drill down levels you're going to find a MACD crossover confirming the turning points within each of those individual chart reversal patterns. We also talked about how reversal candle patterns can be nicely corroborated by MACD crossovers. MACD crossovers can also help you pinpoint strategic levels of support or resistance, such as Fibonacci levels in a retracement. The number one usage of this type of event in the Forex Mentor world is to validate Tom DeMark style trendline breaks, which we took a look at. And we discussed more importantly the importance of establishing a bias before you even look to draw a trendline. Then we noted how in non-trending markets at least, once a DeMark style price projection is fulfilled, it often gives you opportunity to trade in the opposite direction, and a MACD crossover can help identify those opportunities. We looked at how MACD crossovers can help corroborate and be corroborated by reversal signals on other indicators, and finally showing how to draw trend lines on MACD itself and how MACD breaking its own trend line can provide a good secondary signal on a reversal. So that's it for Module 2. If you found any of those concepts flying by a little too quickly, we had to cover a lot of information. Any one of these ideas can occupy its own module potentially. But if you found any of these too fleeting for you, I would suggest just take the opportunity to go back over your own charts in back testing mode. And it's like learning a musical instrument. Practice makes perfect. And just practice using these different concepts and reversal patterns and looking for them. And you'll be surprised how quickly it comes to you. So I hope you found that helpful and informative, and let's move on to Module 3 now.